Getting all set for the opening bell then this morning. We're looking out for the cues from this. Remember, the Nifty has fallen for a third consecutive day on the trot. IT continues to be the biggest sore point, while metals have been gaining ground for the ninth consecutive session. So let's see whether metals can actually push up higher. What we're actually seeing in the market is, while IT is lagging, Pharma is not. So a bit of a diversification when it comes to the defensives, when you're seeing good performance come in from Pharma off late. Just marginally higher, skirting around that 17,640 odd level for the Nifty, flat for the Nifty IT index. The Nifty Bank flat there again. I don't think we've seen such a flat and quiet start in many days to come. There's not any movement on just any of the indexes. Let's see then what Tata Motors is up to and whether that stock is getting excited after that JLR capex announcement of 15 billion pounds. Tata Motors is also very, very quiet, just marginally higher, 0.3%, 471 thereabouts is where that stock is. Ultratech as well, the expanding capacity by 2.2 million tons. Brownfield expansion, that is, in the state of Bihar, 1% higher for Ultratech. Oro Pharma, they've got a US FDA nod for one of the pulmonary disease treatment drugs. Mastech has come out with good numbers and definitely away from what we've seen from Infi as well as TCS. So cheering up higher by about 3%. There's Bank of Maharashtra, which has announced a sizable fundraise, which they're going to consider on 24th, along with their numbers, 7,500 odd crore rupees. That's another stock which is in focus. But weak numbers from Tatacom, weak numbers from ICICI Securities as well. So both those stocks actually should be lower. Let's see what the big buzzers from yesterday are up to, because yesterday turned out to be a good session for some of these OMCs for sure. Both HP, BP held out very smartly. Sugar, of course, has been in a very sweet zone. Yesterday was no different. You had Balrampur Chini hold out by about 2.5%. And I'm only picking up Balrampur because that's the most actively traded one and within the F&O gamut. But yeah, TVS Motors, BPCL, Jindal Steel, these were all some of the active performers in trade yesterday. Today too, actually, pretty much that trend is continuing. But for the index, it's pretty much a no-go right now. Nooresh, hi. Very quickly, what do you make of this absolutely flat start that one is seeing?
So continue to expect same things to continue, wherein we get into a range wherein a dip is a buying opportunity. Apart from that, be stock specific. So nothing really to make out of it, and this is something that should continue for next few sessions as well.
Okay, we've got Atul Suri right here with us in our studios. Let's discuss market trends, outlook on individual stocks as well as sectors. Atul, good to have you here in our studios. I see you've got your sheet prepared. Why is that? Are you adding a lot more stocks to the portfolio?
I have a problem with numerical ability.
Yeah, right.
So
that's something better than that.
So just write down something. You forget,
But not bad at all, right? From the March 29 low of way sub 17K, we made a massive recovery. What next on the cards?
So, Aisha, what happens is that, just as you can see the screen, you were sounding so bored when you were talking of stocks.
What to do?
Like when stocks go up 0.5%, you're reacting to it. So that is actually the state of the market, really. It is very range bound. It is definitely, I feel, in an accumulation stage. Why I say accumulation is because let's take the global markets per se. So first and foremost, you'll see that globally the markets bottomed out in October. Right? Let's take the S&P 500. It's, I think, a very good proxy of global markets. You'll find that since October of 22, where they were almost at 52-week highs, you'll find that the S&P has making little what we call higher bottoms, or in the sense that it is accumulating. And today it's very, very interestingly poised around 4150 or thereabouts. I feel 4200 is a very good level. And if you look at the internals of the market, really, of course, there's, as I said, not much happening in the index. I very often look at 52-week high and 52-week lows. So in the S&P 500, for every 10 stocks hitting 52-week highs, there's only one hitting 52-week lows. So the internals of the market are improving. It may not show in the index. It may look very boring and placid, but internals are improving. Even if you look at Indian markets, right? I mean, today the market is flat, but the number of stocks hitting 52-week lows versus 52-week highs are in favor of 52-week highs. So internally things are getting repaired. And as far as levels go, just as I mentioned, 4200 for the S&P 500, I feel for India around 18.2 will be important. Why I think 18.2 is important is because, this is kind of the budget time. And this is also that whole Adani saga really came out. And after this whole Adani thing happened, the markets lost its shine. We were among the better performing. We were the market actually making 52-week, in fact, lifetime highs. But you will notice that Indian markets have lost their shine. And 18.2 is something which I would think would be important. Hopefully these things would be brushed and behind us. But till then, yes, it could be a boring index. But internally, I think there's a lot happening in stocks. A lot of sector rotation is happening. And as a fund manager, we actually are using these opportunities to realign to new sectors and themes. Because when the new bull market starts, which I think it will be leadership by a new set of stocks, new themes and new sectors. And this is, I think, the very good time to look at, research and realign.
That's already happening in a way. But first, are we disconnected from what's happening in US markets? Because after the Adani saga was also the entire, US banking crisis as well, which also, we saw a knee-jerk reaction of. Are we disconnected or are we completely aligned?
I don't think we are disconnected on a longer time frame. We may be disconnected on a shorter time frame because as I said, October, November, when they were almost at 52-week lows, we were hitting lifetime highs. So at some extent, we kind of front-ended the whole move. We ran up higher. So yes, we are off. We are 5-6% off. Even those markets are slightly off. So in the larger context, yes, there is overlap. Short-term issues happen. You have a banking issue there in India. As I said, you had the whole Adani problem. So a little bit iffy-bitty, maybe not be a day-to-day kind of correlation. But in the larger theme of things, I think if the US breaks out, which I think is what is more likely to happen first, India sooner or later should catch up. But as I repeat, that the big thing for us at Marathon has been to be able to align with new sectors and themes. We think that the market in India and US is showing new leadership. People are still looking at tech and all those famous marquee names, leadership of the last bull market. But the names that are making new lifetime highs or 52-week high are very different. And I think that the new bull market will have a different flavor. And probably this is the best time to realign to that.
Atul, I know you're dying to talk about those stocks and sectors, but I want to, put the construct first. Dollar index, you track that, right? And considering all the commentary from Fed, a pause from here, RBI as well. It's pretty much in a limbo. You don't know which way rates are going to head.
Right.
Some are still calling recession 6 months away, whatever. What are you reading on the DXY charts?
So I think the DXY and US bond yields are two things which are very important because honestly, they do decide the larger flows, whether you like it or not.
Exactly.
I mean, when the dollar is weak, it creates a risk on trade. Risk on trades helps commodities, emerging markets, and India tends to be a beneficiary of this. And I think even US bond yields. Interestingly, for all the talk about recession, etc., bank failures, you'll find that bond yields in the US came off from 4 to 3.3, 3.4. Of course, right now they are again a little higher at around 3.6. I feel that is probably the biggest genie. If that genie remains in the box, I have a feeling that equities, India, US, Europe, whatever you name it, will be well off. So I feel that is the crucial area. That's, I think, the starting point or the single factor that will really move global markets. So yes, fingers crossed as far as that side of the trade goes. But overall, as patterns are playing out globally, I feel that we are bottoming out. There is an accumulation. Globally, markets are making higher bottoms. I mean, we talk of the US, but look at Europe. In fact, if you'll find that European markets are actually pushing towards 52-week highs.
Yeah, the CAC, the FTSE.
Right. A year ago, when the whole Russia-Ukraine thing was there, gas prices were zipping, everyone thought like it's the end of Europe. But look at our predictability, that actually it is Europe that is making or leading global markets higher. Yes, it doesn't pull its weight. US is more important. But I think sooner than later, the US will also get there. There's an accumulation phase. It's a painful phase. It's a boring phase. Movements are not much. You find a lot of difficulty to cover a lot of stocks and stories. But
Nikunj walked out of the studio. It was that boring, right?
I just wanted to grab a cup of coffee. Nothing in the coffee.
For me, in fact, I just put my laptop flap down and do other stuff. Because
so what's
honestly,
keeping you busy these days?
Honestly, because
what are you telling your clients? Kuch nahi hai.
No,
They'll pull out money. Don't say that like this.
See, you just walked in, right? If you sometimes sit, you can hear. So, Nikunj, what I find that is very interesting is that what I was telling Aisha earlier was that leadership is changing. there is a lot of churn that is happening. Number of stocks hitting 52-week highs. There are many of them.
L&T, ITC.
Yes, exactly.
You
They are
bought L&T?
decadal underperformers.
You bought L&T?
IT is down, Pharma is up.
So just to come to that, which was something which I want to take on, that sectors or themes, because we look at themes and we think 70% of your work is done if you get the theme right.
Yeah, true.
Right? So we find that electrical equipments,
Equipments. Okay.
engineering,
Okay.
these are sectors which have been decadal underperformers.
How much weightage do you think one should have? For example, if we use Nifty as a benchmark, 30% is financial. So you need to stand somewhere closer to it.
Right. You don't have to.
I mean, that's what fund managers do, right?
Yes, but I am not.
Okay, that's what.
I'm underweight. In fact,
You're
shockingly,
underweight
there's
financial.
consensus bullishness on banks. We have banks, but they're more commercial facing.
Yeah.
They're more commercial facing, so we feel that is where the move is. So even if the banking moves with a lower weightage, we will get a bang for a buck, because we feel that we are in the lighter space. We actually favor industrials, commercials, hardcore infra, capital goods, very different from themes and sectors that dominated the last decade.
So how do you decide the weightage then? I mean,
So as I said, our largest weightage is electrical equipments.
how much is that?
We have about 15-16% there. We have about
15-16%.
But
Yeah.
Atul, that's not an index mover, right?
In fact, as a portfolio manager, my job is not to hug the index. If I hug the index, I am not adding value. Then a person may as well go into a passive fund, an ETF. My presence or my value is only if I can create disassociated outsized returns. And that would come by not hugging the index. So we really do not try to hug the index. And that is why you will have sector bets like, as I said, electrical equipments. I think engineering is another very interesting space. Defense is another interesting space. These are sectors and themes which may not have weightages in the index, but we feel that these are stocks and sectors making new highs. And that is what will create the alpha going ahead, and that is where leadership is. So that's why I've been emphasizing that not much is happening on the index. If you're an index hugger, there's not what happening. I mean, if a Reliance goes up, Infosys comes down. If a L&T goes up and ITC goes up, something else is going down. So net, you're setting off. But in that also, there are a lot of opportunities. Sectors and stocks are doing well. And as and when we come out of this grip, you will find that leadership will come here. And as I said, that ultimately they have been decadal underperformers. They are under-owned.
Now also,
I feel so. I feel that if you look at weightages per se, people have not even got to at par levels. And that, from moving underweight to overweight, when the trend or when the movement happens there, is I think a great opportunity and will give a lot of momentum to these spaces or these sectors.
So if you have to, let's say, talk about the strength in some of these stocks.
Right.
Do you expect them after a decadal underperformance to be a outperformer for at least 3 to 5 years? And we are at the beginning of a multi-year or a multi-quarter outperformance in cap goods, engineering and electrical stocks.
I think so. Because, we saw that last year. Yeah. Right? Look at PSU banks. I mean, last year the index was flat, 3% positive, and a PSU index went up 70%.
Yeah. 30%.
So what really happens is that sectors that have underperformed for so long, people naturally get underweight. And sectors which have done well, people are already overweight. So the shift that happens or the sector rotation that happens actually is a very big trigger. So I think if you get your themes right, if you're thematically correct, 70% of your work gets done. 30% is about picking the stock, but 70%, it's like a boat, If the tailwinds are there, your sails are up, it will take you. You may have the best sail and the best boat, but if the tailwinds are not there, the boat doesn't move. So I feel that getting these themes are important. And when themes change, they become very big opportunities. And I think that this is the stage. I know in the boredom of the index, we all experience that. But if you start looking at stocks and you start looking at sectors, I think there's a lot happening there.
Atul, so you had a target of 21,500 on the Nifty.
Yes, I do have it.
That will not change.
No, I'll tell you what has happened is, Nikunj, it may have got pushed back. I would have thought it would be more front-loaded because the way we were panning out at the budget time, etc., we had absolute leadership, we were global leaders. I feel that this whole Adani thing that has happened, though we are not able to quantify it, but when you have so much wealth destruction, there is going to be collateral damage. There is going to be, somebody has to pay the price. It's not a free lunch in this market. And to some extent, the way India is behaving right now, I think it's a pain and price we pay. So what could have come earlier, I think will get pushed back a little bit. But I do still feel bullish looking at the internals, looking at the way global markets are, that we are headed higher. we are headed higher. May not be a big index move, but focusing on these themes and sectors that we spoke about, I feel will be a big outperformance and alpha generation in the year to come.
What's in your short portfolio? You said that banks
I
are...
don't have a short put.
Okay.
I may just be underweight.
What are you avoiding?
As a
What are
PMS,
you
we can't go
underweight?
short. No, we are not really. So let's say like, I'll give you an example, like auto, right? You generally talk about the 3-4 big auto companies. We have auto, we are overweight auto, but we are overweight some of the ancillaries. You know, so such places, we are overweight even FMCG. Like things like telecom, we don't have any positions. Media, we don't have any positions. So these are sectors we are underweight. AMCs, broking, insurance, all places we don't really have. We have zero holdings in those spaces. Because if we create an overweight in some space, we will definitely have to be underweight. As I said, banks, financials, consensus bullishness. Everyone talks about the credit cycle. Everyone talks about clean balance sheets. Yeah, that's good. Everyone knows about it and we know the numbers are going to be good. Even in banks, I feel it is the industry-facing banks that will do well. So just getting into everything and hugging the portfolio similar to the index, I think is not about adding value for a portfolio manager.
Are you
We
close
have
to
to be
buying
differentiated.
IT yet? Are you underweight there?
We are underweight IT. We just have one IT stock, but that also is a mid-cap IT stock, which is actually pushing to lifetime highs.
KPIT.
What about metals, where that stands?
I think metals also is very interesting. Metals as a sector did very well last year. However, it has kind of corrected. But again, in metals, there are certain derivative plays on metals. So we do have a position even in that space. So as I said, that I personally think that the whole thing is about the whole industrial cycle, the whole engineering, infra, these kind of manufacturing. And this is not just in India. This is happening even in the US. Industrials as a theme, as a sector are doing much better than tech or all the new age businesses. Of course, all the eyeballs and all the stories are about the tech because there's a lot of storytelling you can do there. And
Look
these
at
are
what was
boring
happening
companies.
at the Apple Store launch.
Absolutely. But these are boring companies and boring stories. But I think that the tide is changing. And I feel that going ahead, these will be bigger wealth creators here.
Right now, the tide has turned for IT. A leader has become a laggard.
Right.
At what point in time you would say that the pendulum of market sentiment, which was only optimism a year ago, is now only pessimism? When will it return back to normal?
I have a feeling, Nikunj, that when I look at the IT stocks also, that the mid cap and large cap are behaving very differently. Okay. Right? If you see the large cap stocks, we have those 4-5 marquee names. You'll find that they actually do not have much happening. The trend seems to be down. But even in the mid-cap space, there are 3, 4, 5 very good names, as I said, which are pushing towards lifetime highs.
How many stocks do you own?
20.
20.
Yeah.
And as of now, it is a combination of FMCG?
I think electrical equipments dominates, FMCG, engineering, metals, defense, auto ancillaries.
What will force you to relook at your portfolio where the 15% overweight, which is a combination of electricals, engineering and defense, you could be forced to trim it or revisit it?
Two things will happen for a trend to change. One is that the earnings, because ultimately it's earnings that drive prices and it's not the other way around. If prices only move without earnings, it ends always badly. Right? And we have seen that in the last few months with some very, very marquee names. So the first and foremost thing that will trip Nikunj's earnings. Okay. And once earning trips, you will find that these stocks start tripping even in terms of prices. So the confirmation, it's almost like a double barrel gun. Earnings, trending earnings drive trending prices. And when we see a change of trend in earnings and prices, you can decisively say that the trend has changed. So that is the way we are trend followers. We really don't try to predict because honestly, as I said, our ability to predict and the way the geopolitics are playing out is very, very limited. But what is reflected is in earnings, the reported earnings, 3 quarters, 5 quarters, 5 years down the line, in fact, managements themselves don't know because a lot is changing very fast. But even reported earnings and reported price, two things which we know, which are visible, there's no conjecture, there's no difference of opinion. Even if you study that and do and work with them in a disciplined way, I think that there's a lot of wealth to be created. And that is why our style of investing is about trend following. We are not trying to predict the world 5 years later, 10 years later. Honestly, nobody knows. Nobody knows. You can go back and look at predictions 5 years ago and most people have been very, very off the mark. Somebody gets lucky and they tom-tom about it. But the important thing is that we know the now. We know what the market is telling us now. And if we are able to analyze that properly, that exactly is how we look at markets. That is what trend following is about.
Okay.
Two charts, Brent as well as copper. What are they telling you? Because Brent no more is at that comfortable level. I mean, I know we ignore it now,
Yeah.
but it's back at 80 plus already.
No, I think that was a real surprise because the way Brent cracked around 70 or so, I had a target of 65 on Brent, and I still think it will come. But the fact was that it would have a lot of good spin-offs for Indian corporates, profitability, and a lot of other such areas. Get with low prices, especially in the commodity space. But Brent has surprised.
Yeah.
It came to 85 or so. Right now it's 83. I think up to 90 or so. There's a lot of politics also around this whole Saudi, Russia, whatever nexuses that there are. But only beyond 90, I think it is a cause of discomfort. I still feel that the trend in Brent is down. I still have a longer term target of 65. We went to 70, but I do think it will drift lower. But yes, in the short run, also what happens with commodities and all these places, commodities, you will find that in bond yields, you will find that in the dollar, that they're extremely oversold. You see, they've had a one-way down ride for the last 3 to 4 months. So when these things get very oversold, they're not very, very strongly trending. They tend to have a bit of a reversal or a pullback. So the fear is that yes, they can have a pullback, more of an oversold rally, but I do think that the trend is lower for these asset classes, and this will benefit equities. It can get delayed, but I don't think it is going to get denied.
What about
about
Dr.
gold?
Copper though? Sorry, before that. Yeah.
I think metals also are interesting. I know, like we had written the end of metals, etc. But metals also in the last few weeks, they have been actually pulling up, and they are making a base. As I said, they're not going to be the runaway that they were last year. But even if they remain at these nice levels, there would be opportunities. That is why we are playing the metal space through derivatives. It may not be the 3-4 large marquee metal names, but there are a lot of other industries that are linked or suppliers to these, and I think that opportunities are there.
I'm amazed when I see Bitcoin. It is supposed to be the leverage, the risk-off instrument.
Right.
You're talking about slowdown in the world, concerns of inflation, and here is Bitcoin, which has popped right back up.
Yeah, it's the best performing asset
80%.
class in the world year to date.
80%.
Yeah.
Yes, the best In fact, Nikunj, what you rightly said, that everything is the opposite of last year.
Yeah.
Exactly.
The worst performing asset class is the best performing. Even you look at NASDAQ.
Yeah.
It got hammered last year. From year to date, obviously they are doing well. So, and that really
And your
brings
fund
down.
performance this year opposite of last year?
Yes. Last year was a difficult year. Last year was a difficult year.
I'm glad it's come back
because,
here.
Because it all comes down to growth and value. See, the whole ultimate trade was about growth and value. Last year was, growth done well decadally. And last year was pretty bad for growth. Very bad for growth. So everyone got caught in the reversal trade. But what you're noticing as bond yields have corrected, that the re-emergence of growth. And I think this is because we do a ratio chart between growth and value. We find that after a very sharp knockoff, and this knockoff or this underperformance of growth relative to value was decadal underperformance.
Yeah.
So that is why last year was a very, very difficult year for most asset managers. Because ultimately we are growth investors. In India, you
India
come
is
to
a
invest for
growth
growth.
investment, yeah. No,
So
fair point.
this year actually has started off very, very well. And a lot of the pain of last year has already been undone in the last few months. And as I see things playing out, I feel that you will see the re-emergence of this in a very big way.
What amazes me is another chart, and historically we've been programmed to think weakness in dollar, strength for emerging markets.
Right,
Weakness in
right.
dollar, strength for commodities.
Right.
Weakness in dollar, and you briefly spoke to Aisha about that. I was hearing the conversation. I may be out, but I always enjoy hearing your conversations. It is not playing out as per the script.
May not be perfect, Nikunj, but if you look at the bond yields, which are over 4, came down to 3.3. In that phase, you'll also find equity markets bottoming out. That October to now phase that we are talking about, you'll find that where the USD had reached to where it is right now. So all these two, especially the dollar and bonds, they have kind of corrected, and this has actually helped equities. The S&P 500 in the last 3 months has done a wonderful accumulation. And internally, as I've been saying, the number of stocks hitting 52-week highs versus 52-week lows has improved dramatically. So I think things are getting repaired. Yes, at an index level, it's a bit boring.
Intellectual level, you can say that. Yeah.
It's a bit boring, but internally things are changing, sectors and themes are changing, and I think this is a very good time for.
Well, we've been not stock specific, but
I think we spoke extensively on
which
many
stock
themes.
did we speak about?
Nothing.
So no disclosures.
Electricals.
You're happy
I
your
don't know
time
what
is
that
up.
So I think we discussed themes because I said if you get your themes right, 70% of your work is done actually. I mean, in electrical equipment, how many stocks there are? There aren't many.
I can actually think of few.
Yeah,
Even the large ones.
Exactly, because what happens is that when sectors go through such a long period, there's a big shakeout. A lot of companies close down and get eliminated. What stands are a hand few. And when the cycle turns, these are disproportionate beneficiaries. And that's where we want to be as investors.
Type 1. Atul, always a pleasure to have you.
Thank you.
So at least hope to see much more of you going forward.
Thank you.
What do we have on the markets? Well, the bias is positive. That's what you need to focus on. You may see a crack here, a crack there, few patches of high volatility, but that does not really change the big picture according to Atul Suri. He believes that electrical equipment, machinery, defense, that's a space which has been in marked outperformer. He feels that that's a long, long way to go. Meanwhile, markets, what do we have? The breadth is looking better. The breadth is looking decent, and there is a definitely tilt towards small and mid cap stocks once again. Okay. Shriram Rathi joins us now, India analyst and represents the pharma and the healthcare vertical for PNB. You've got Cinderella, she's the lead pharma analyst with GM Financial Securities. So let's take that conversation forward. Good morning to both of you. Thank you for joining us. I'll start with the lady first. Cinderella, if one looks at the comeback in pharma, do you think this is backed by evidence that pricing, US FDA audits and the demand has bottomed out, or this is just a dead cat bounce? It is pure sectoral rotation, nothing else, nothing more.
To our understanding, we believe that the sector has experienced a COVID reset, basically. So we have seen the reset of COVID coming back. Now it is behind us. The entire earnings trajectory that we had seen going northwards in FY22, now we have a new base in FY23. So from here onwards, the valuations will move to FY25, and that gives us an opportunity to look at this sector. From a US FDA perspective and US business perspective, we believe that generic Revlimid will help most of the companies to give us sustained earnings for another 2 years or so. And with that, what happens is the pricing pressure on an overall basis looks stable to minor, given that we have a support from a larger product. And when we look at the domestic market also, we see at least 11-12% FY24 domestic market growth, which kind of gives us a lot of comfort on the overall earnings trajectory going ahead.
Right. Shriram, if I could just get you in on the discussion as well, and, wanted to understand, given the fact that Nifty Pharma has underperformed Nifty 50 since 2015, barring the calendar year 2020 when you had that, marked outperformance, now things are turning sort of for the better. Do you see possibilities of a re-rating for the sector at large?
Yeah, as you rightly mentioned, Nifty Pharma has been underperforming Nifty PE. The premium used to be around 30% odd for Nifty Pharma over the Nifty PE, and that has gone down to almost 15 to 20%. And now we are seeing some kind of reset happening on that front. So our expectation is that the outlook is definitely positive for the sector, and we are expecting double-digit earnings growth over the next couple of years. That should help in maintaining the valuations, and there will be some pockets in terms of companies who will be doing much better, and that's why we are positive on select stocks. So definitely we are on the sector.
Right. Cinderella, just looking at the margin squeeze that has been felt within the sector in the last 2 years because of pricing pressure in the US generics on one end, and of course input cost inflation as well on the other one. Do you think this year that could get reversed by any chance?
Yeah, so probably the entire raw material inflation with the crude prices also coming off, we feel that it is in favor of the sector. We believe that over the FY24, we should at least see across sector, we should at least see 1.5% of margin revival coming at the gross, and the logistical cost and all at the EBITDA level also supporting us. So we do expect a revival on the overall margin aspect expect, largely from a raw material inflation softening as well as logistical cost softening, we do expect a margin better than previous years for sure.
Right. Sriram, do you believe that domestic sales will continue to grow in a better way compared to the US markets here for India?
Yes, definitely. I mean, India domestic market is more of structural growth story for us. And we expect that over the medium term, the growth will remain in double digit, somewhere in the range of 10 to 11%. While US has been deflationary in nature, there it's more of technical play. So after every 2-3 years of price erosion, generally we see some kind of sanity coming back in terms of price erosion. So that is a time when those the US generic focused companies do well. But India is more of a structural growth story, and that will remain. And that's why the valuations are at much premium for Indian companies compared to the generic companies.
Right. You know, the other thing, Sriram, there are reports of drug shortages in the US as well. I mean, the March numbers were, I think, at 301, which is the highest since 2014. And we've seen a negative correlation of drug shortages with price deflation as well. How long do you see this situation continue in the US? And this time around, are there different factors impacting it all?
Yeah, so what has happened, I mean, post-COVID, suddenly we saw significant spike in terms of USFDA inspections, and there have been certain adverse reactions also because of that. So, for example, Sun Pharma's Halol facility got import alert, then there have been certain other instances, so which has led to some kind of shortage, and the companies who have clear FDA status should basically will stand to benefit because of that. So this time, nothing specific as such. I mean, we have seen at times the shortage list goes up significantly, and then gradually we see that the competitive intensity in those products increases and the shortage list goes down. So right now, definitely it is on the higher side. That's why we are seeing some kind of traction in the US focused companies. But I mean, it's not a structural thing. I mean, probably in few quarters, we will again see some kind of sanity coming back.
Right. The focus of select companies recently has been to enlarge their specialty drug portfolio. For example, a Sun Pharma. How big an opportunity do they offer for growth?
So it's a new engine of growth for the company, Sun being the only person today present in the specialty side with Illumia, Sequa, and other products like Winlevi. So this is a new leg of growth, and it has an immense potential. But we being the generic pharma company, this is a new segment for most of the other companies. Plus, this needs a huge amount of investment also in the US market to be successful, because you will be competing with the innovative companies in the US. Hence, we believe that this area segment needs higher investment, longer gestation period, but it's a long and a sticky business, which definitely Sun Pharma's earnings will benefit over coming 2 years, 3 years, I mean, and henceforth. And that's we see and we prefer. One of our topic is Sun Pharma from our coverage perspective, and the specialty is the major reason for this kind of growth.
Right. Cinderella, I have to ask you about Mankind Pharma, the latest IPO offering, whether it's a subscribe.
So we have not given our official view on that as such, but of course we attended the analyst meet yesterday, and I think it's one of the largest, fourth largest company in India which is coming out for an IPO. And in terms of overall CAGR growth, I think there is a significant growth opportunity that the numbers have shown over last 4-5 years, and we look forward to the listing as we go ahead. And it's a kind of acute and a consumer health, and they want to grow with a large focus from a chronic segment as well as consumer health business, is what we understood from the management yesterday. And that's how we look forward to this IPO, as it will be one of the largest company IPO in a while in pharma space.
Yeah. Sriram, I'm sure you've looked at the DRHP for Mankind.
Yeah, we have looked at that, but of course we have not covered it in any of the reports. But I mean, the only thing is that, as I said, that India is more of a structural growth story from the long-term perspective, and there is a lot of appetite in the investor community for the India stories, India-focused stories. And Mankind has around 97 to 98% revenue coming from India. I mean, for the industry, our expectation is that it will grow at around 10 to 11%, and there will be certain companies will be growing faster than that also, depending on the portfolio. Definitely interesting company to watch out, but can't comment right now. Thank you.
Cinderella, morning now, like the pre-COVID time, there was also a time when every other day we used to hear about plant inspections, ANDAs and more. But do you think that now on that front, the news flow has dried a little bit, because data does suggest that there has been a sharp surge in ANDA withdrawals? So what's the outlook like for 2023 with respect to ANDAs and withdrawals?
So I'll try and take it in a different way, because what happened is during the COVID phase, most of the US FDA inspections were not conducted because of the travel and other restrictions. So we saw resurgence of all these inspections happening starting last year mid, and they are continuing in the similar space. And in fact, we are seeing increased ANDA approvals. We've highlighted that in our recent report as well. So we are seeing that as these facilities get clearance, we will see more and more approvals coming in for most of our Indian generic players. And in fact, we expect a patent cliff to start soon, which will also start somewhere FY24. So we look forward to more clearance coming up and more compliant facilities. We are the leader in terms of domestic compliance. If we look at the US FDA supplies, we have the highest number of plants in India which are US FDA approved, and we are known as global pharmacy as well, with the kind of supplies that we do to US and other regulated markets. So we do expect approval cycle also to pick up, as well as we have seen inspection cycle also at a higher trajectory because of post-pandemic impacts.
Right, and wanted to get in a take from you, Sriram. Within the pharma conglomerates, which one do you believe is going to benefit the most, given the kind of tailwinds at play for the sector?
Yeah, so our top picks in the sector are Sun Pharma, mainly because of their specialty pipeline and strong India exposure. Followed by JB Chemicals in the mid-cap space. Again, India story mainly. And in terms of US-focused companies, we like companies such as Aurobindo Pharma and Dr. Reddy's, because whatever tailwind comes out there, they should benefit the most.
All right, Sriram, Cinderella, thank you so much for taking time out and joining in, giving us a take on the pharma sector as a whole, what some of the key tailwinds, headwinds are, and what the roadmap is going ahead. Just taking stock of the markets then, and at the current juncture, we're flat on the index. We've been talking about it being pretty boring, but yeah, individual stocks, no doubt, do manage to catch the eye. So just let's run you through some of the movers on the Nifty 500, for instance. Lux Industries actually is seeing a double-digit gain. You've got a Shoppers Stop as well. That's a buzz. Chalet Hotels, Lemon Tree Hotels, that was Nooresh's pick, doing quite well. SKF India and something like a Mahindra CIE as well is active in trade. But let's get a move on then and connect with Umesh Chaudhary. He's joining in, the Vice Chairman and Managing Director at Titagarh Wagons, here to talk a little bit about the market share as well as the kind of order book and of course the record revenues on the back of the big order wins recently. Thank you so much for joining in, Mr. Chaudhary. To begin with, the freight wagon segment order book, that has seen pretty healthy growth. There's that large order as well that we'd spoken about. I just want to understand what the outlook is going forward. Where do you see wagon ordering headed? Is it going to grow at a higher pace than it is currently?
Yeah, good morning. Pleasure being with you. So yes, absolutely. I believe that the Indian Railway, the stated policy of the Honorable Prime Minister of the Government of India is to reduce the overall logistics cost as a part of the GDP, and this can only be done by a paradigm, a kind of a shift from the high cost mode of transportation to the more cost effective mode of transportation, i.e. railways, waterways. And the whole Gati Shakti program of the government, the way the government has been spending on the railway infrastructure is a very clear signal that the railway market share is bound to grow. And I have always maintained that in the first 7 years of the government, the government has done a miraculous work on spending in terms of infrastructure creation on the railways. So basically, when they invest in the track, they invest in the signaling capacity, they invest in the locomotives. what they are doing is they are creating capacity. And in order to utilize that capacity, they need more wagons. So now the kind of the last end of the spectrum is coming in, which is requirement of more wagons and growing the traffic.
Okay, fair enough. So what is the outlook when it comes to the private wagon market over the next 2 to 3 years in terms of where the company is going to stand, your market share, and how you plan to scale?
So we have been leaders in the market for wagons. We of course would endeavor to maintain our leadership position. As far as the private wagon offtake is concerned, we've read in the news that the new approvals railways are not giving for new WIS wagons, but that really doesn't really make a difference because the existing applications or the existing approvals are so large that it would probably kind of sustain the next 2, 3, 4 years of take. So on the overall basis, now our company is at a level of about 700 wagons a month, give or take a little, and we intend to get to about 1,000 wagons a month over the next few months.
Mr. Chaudhary, the passenger segment includes metro trains as well. What is the outlook there, and especially when it comes to new metros that you've been bidding for?
We are extremely excited about the passenger rail side of it, because on one side, we've created a capacity to make metro coaches where we are executing now the Pune Metro, then with CRRC, we are executing the Bangalore Metro, or we would start the execution of Bangalore Metro this year. We have bid on a number of other tenders. And it is again one of the stated policies of the government that there would be metros in every large and medium-sized cities. Metro also, incidentally, is very aspirational. So, it is directly related. It is seen as a direct corollary of growth and prosperity. And it is necessity. Say that for the urban transport, with the congestion of the roads, with the pollution, with all of that, it is a necessity. So in a country like India, which is densely populated, metros are going to be there in the future for times to come. Having said that, so while we are very excited about the metro, I think the big other opportunity that we have is the Vande Bharat opportunity. So we are now basically setting up a parallel production facility within the same plant to produce both Vande Bharat and metro simultaneously. So we believe that on one side, the long distance travel, that is Vande Bharat type of travel, is going to be there. On the other side, the metro business is definitely for urban transport systems is going to be a thing of the future for the country.
Oh yeah, absolutely, and what a great opportunity for you. But Mr. Chaudhary, the one thing is that the margins in this particular segment are low by about 3 to 3.5% kind of range. And please correct me if I'm wrong. Is there scope for the margins to be pushed higher at all?
Absolutely. You see what the margins you see in our financials at this point of time is the startup margin. So we've really not stabilized. So we are now producing hardly about, if you see it on an average, maybe one train a month. So one train a month, our fixed cost remaining what it is, obviously the margins are impacted. Our targeted capacity is far, far, far higher than that. So we believe that the margins we've always maintained that our overall margin guidance is between 8 to 10% for both FTRS, which is freight rolling stock, and PRS, which is passenger rolling stock business. And we believe that that is something which is a pretty manageable or achievable for both our businesses once we, of course, reach a certain base volume.
Right, that's great. Tell me a little bit more about your Vande Bharat orders as well. What's the execution? What is the gestation period? And what kind of margins are you hoping to make there in specific?
Sure. So Vande Bharat is a like I say it internally, my company, that it's a transformational opportunity that we have got, not only as a business, but also, becoming a part of the national growth. Vande Bharat is also a telltale sign of the new India, if I may say so, the modern India and the India of the future. So this is a contract that we've got along with BHEL for manufacturing, supply, and maintaining of 80 Vande Bharat trains. The total contract value would be about 24,000 crores. The first train has to be developed and manufactured and supplied in 2 years, and thereafter all the other trains would be within about 4.5 years thereafter, and then there is a 35-year maintenance of all these trains. We would be producing the base coach in Calcutta in our plant, and the final testing assembly would happen in the railways facility in ICF in Chennai.
And given the kind of visibility that you have on orders, do you have the capacity to fulfill these orders? And what's your capex target for the next 5 years?
So we had stated that about 2 years ago that our total capex for this entire plan is about 1,000 crores, out of which about 300 odd crores is already spent. We have decided not to put new capital allocation on the shipbuilding and bridges and defense business, business right now for the next couple of years, because we also have the wheels tender that we have won along with Ramakrishna Forgings. So with all of this, our capital allocation is really happening only in the railway space, and this is also kind of our strategy is reflective in the decision to change the name of our company into Titagarh Rail Systems, which is now in front of the shareholders for their approval. So we would be focusing on the capex, on the capital allocation only on the rail business, whether it's increasing the Vande Bharat capacity or setting up the new wheel set facility.
Okay, and are you looking to shift focus from wagons to maybe other segments and industries? What kind of revenue potential do you see from these businesses? If you could give us some sort of a timeline as well.
Sure. So the other big one which is there is the wheel set business, where we partnered with Ramakrishna Forging, and we've won this tender from the Indian Railways. This entails setting up a kind of a greenfield plant for manufacturing of wheels, and it's a very interesting model, because Indian Railways have always had problems in terms of availability of wheels, and for the last 25 years that we've been in the wagon business, one of the questions that we've been faced, and we faced within ourselves also, is timely availability of wheels and wheel sets. And in a country like India, we didn't have adequate capacity, and we ended up importing them. So if you really look at this tender that has been floated and finalized by the railways, this is going to be a very important milestone for the railway industry in India, where 80,000 wheels for the next 20 years is going to be purchased by the railways. But that gives us the base load to set up a new plant, which will not only cater to this tender, but cater to the other requirement within India and export requirements. So we partnered with a wonderful company, Ramakrishna Forgings. They are leaders in the space of forgings, and we have our expertise on the railway side. So it's a wonderful combination, both from the manufacturing expertise perspective and the market expertise perspective. And we'd be setting up this plant.
Right. Mr. Chaudhary, we've been reading notes on how you've been inviting brokerages to your factory visits, wondering when is ET Now's turn.
You're most welcome any day. It'll be a great honor and pleasure for us to have you there.
Okay, we will definitely take you up on that for sure. Great to speak with you today. Thank you so much for taking the time out.
Thank you very much.
Okay, that's the word coming in from Titagarh Wagons. And what an exciting phase the company is currently at, especially with the Vande Bharat trains, with all the metro launches and the kind of order book that they're sitting on, and more importantly, the margin visibility as well. That is what the management indicated, that it's going to eventually go in much higher than that 3 to 3.5% range that they're currently making. Titagarh Wagons, 8.5% higher right now in trade.
I just want to mark Z actually, Aisha. Some flashes coming in at the bottom of your screens, which state from agencies this is that Z Entertainment is set to start the talks with creditors to close the Sony merger. Now, remember, this had been the silver lining or the bright spot, really, that a lot of analysts were looking at, the closure of that, merger with Sony. And just recently, you had the news coming in about Oppenheimer, which had completely exited Z Entertainment. They had sold their 5.6% stake, and they had ended a 2-decade-long association as well with the company. So in light of all of this, I'm sure this positive news will definitely be taken. It was in September of 21, nearly 2 ago, that Z announced this merger with Sony. It ran into a lot of trouble as well along the line because the largest shareholder had opposed it. We had seen Invesco come forward. They had had an EGM as well to remove the managing director and CEO, that was Puneet Goenka, along with the 2 other independent directors. They had sought the appointment of 6 of their own members on board, and they had called, for a lot of other issues. But you had Invesco completely withdrawing that request then, and they actually went ahead and said that the merger in the current form has plenty of potential for the shareholders. In the month of October also, you had CCI that actually approved the merger with some conditions, and that now we have some more perspective as well coming in, that IDBI Bank and Axis Bank are among the creditors now seeking repayment. You had IndusInd Bank very recently, but the fact that they're in talks with creditors to close that Sony merger, I think the street is also taking that well. 198, Aisha, is where Z Entertainment is at.
Yep, forever in the thick of news flow, that's Z for you. But live visuals coming in from New Delhi, the Apple store at Saket as well, which is currently opening, and that is Tim Cook taking selfies with some of the customers, and as charged up, if not more than they were at the Apple BKC launch. If we can just cut to those visuals, and then perhaps we can take a break from there.